All right, everybody. In this video, I'm going to go over mean reversion, buying low, selling high, and asset returns from different sectors and different markets, small, large cap, value, growth, and whatnot, in the last about 15 years or so. This is pretty useful information. If you leave the links on the description down below, it shows all the data. It's a pretty neat website that shows all the data from different asset classes. All right, so if you go to the website novelinvestor.com, there's two very useful tools on different stock market returns. This goes all the way from 2007 to the first half of 2019. This should update to the full 2019 January, whatever the year ends. Now, on the bottom shows the different types of industries: consumer discretionary, staples, energy, financials, healthcare, and this is all based on the S&P 500. If you click on any particular industry, so let's say we're looking at industrials, it's going to show the returns of this industrials from every year from 2007 all the way to now. Just quickly glancing through them, I want you to see if there's any particular trends you might notice. That was pretty dramatic. So S&P, that's just S&P 500. So if you look at quite a few of these, and finance, and what was INFT, information technology, there's pretty dramatic highs and lows. You might have 1 or 2 years of pretty good returns, and then typically it'll go lower, right? Energy is a big one. You'll have some years that are really, really low, and then some years that are much higher, okay? Next, we're going to look at asset class returns. These are for just general broad base. The large caps are orange, that's S&P 500. Small caps in blue. International developed, those are bigger international. You have emerging markets, REITs, high grade bonds, high yield bonds, and cash. Notice again, I'm going to go to different asset classes. Notice the changes. Large cap value doing really well this year, 18.5%. And notice the trend, it is staggering. Some good years, some bad years. You don't see many that are in the middle of the road every year. Okay. So what are some takeaways from this? One is you're not sure which asset class will necessarily be the highest next year. There's no way to really predict that. In general, if one had a pretty good year, there's a chance that it might be lower the next year, or there's a chance it might be near the same. One of the big takeaways, I think, is to not necessarily focus on one particular asset class as your sole investment, because then it could make it much more difficult to time when one will go higher or lower. I do own a pretty even percent on most of these asset classes as well. Let's look at mean reversion. Mean reversion is the theory that asset prices eventually revert to long-term means on averages. So if we're looking at certain years that were very low in percent compared to others for a few years in a row, mean reversion theory is saying that there's a good chance that it might be higher in the near future to even out to get back to the mean. Right? Change in returns can be a sign a company no longer has the same prospects. Then obviously if there's some inherently wrong thing of a company, it will lower that as well. Right? So key takeaway, asset prices in historical terms eventually revert to the long-term means. If you look at, say, REITs had a few good years in a row. So year in 2013, 2 more good years. And then it leveled off for 3 years, stayed middle of the pack. Probably reverting back to the middle. Small cap and small cap value has quite a few really high years, 21, 38.8%. But the last few years, middle, near the bottom, slightly higher. So there's a good chance it might level back out. Okay. Buying low and selling high. That's one of the key facets of investing. I mean, there's no way to say it otherwise. Obviously, you want to be buying things that are at a low price, keeping them while they increase in price, and then selling them at a high price, right? So by buying all these different asset classes, or a good variety of these asset classes, if you have a set percent of what you want in each investment there, let's say I put 10% REITs, 10% large cap, 10% small cap, and so on, you're going to be getting all of these returns. So one year, let's say rates do really well, like they have this year, you're going to have more in your account than the 10% in REITs. It might be 13, 14%. Let's say cash was one of your investments and cash didn't do nearly as well as the other ones. You would have maybe 6, 7% in cash compared to the 10%. Okay. So by buying low and selling high in this regard, you would buy a little bit more of these lower asset classes because they went down in your overall portfolio percentages. And by doing that, you'd be selling some of the higher ones. Again, look at the mean reversion. A lot of times, you're going to have some good years followed by some not so good years. If you're buying low and selling high by keeping an asset allocation that's appropriate for your risk tolerance, then you should be good in terms of getting the right assets that you need. And I think it lowers your volatility. That's the bigger differences in how much your accounts will be over time. So if you have any questions on this, mean reversion, let me know. I'll be doing a video pretty soon about my percentages of my assets and then how I might be making changes as well in my portfolio.